Hey. Welcome, everyone.
Waiting
Sorry, I
for
got Jason on
participants
the
to enter
phone.
the room. Give them a few minutes, and I'm watching this. Hello, participants who've joined us. We're waiting for that number to ratchet up to our full participation. It's like entering a Taylor Swift concert, but not quite. Welcome, everyone, to our webinar. And boy, is this a good topic to be talking about today. The topic is going to be the end of an era, how deglobalization will lead to a structurally different world, presented by Janus Henderson. Edward Nasser is going to introduce our speaker. I would remind participants that there is a Q&A button that I'm going to be monitoring. If you could raise your questions in the Q&A button rather than the chat, that would be most appreciated. So I'm going to turn it over to Edward Nasser to introduce our speaker. Take it away, Ed.
Thank you, everyone, for joining. Apparently, my camera is not working. I'm at the Townsend Hotel in Birmingham, Michigan. So you're going to hear me, not see me, but I am local. I'm hanging out here to just quickly introduce Nick. I know many of you out there, and we want to thank you, everyone on the CFA chapter here in Detroit, for setting this up. Certainly, Jason for hosting, Lauren, Michelle for organizing, and we're really grateful to be here. I want to set this program up for you and just quickly introduce Nick. We're very excited to talk about this subject, but I will tell you, Nick has been talking about this for the last 10 years or so. Over the last 4 to 5 years, people have started listening to Nick because a lot of what he has said has started to come to fruition, culminating in the most recent November 3rd election, where obviously globalization or deglobalization has come into question in regards to the new administration, and we'll talk about that. Nick's construct here is really based around the ideals that have to do with what's happening with the insourcing, and that was expedited through COVID into American-produced products, services, technology, healthcare, and so on. And what are the investable ideas for you all that are listening today? What are the initiatives and ideas and investments that will affect you and your clients going forward? In regards to Nick's bio, I would love for him to share a little bit about the early days, but he ran assets over at Marsico, had an incredible military history, and started running money for Janus Henderson over 12, 13 years ago, and runs 3 of our premium strategies who have been centered in the 4, 5-star categories in large growth under our Janus 40 fund, which also comes in a concentrated SMA. It's been very successful for us around growth, large cap growth in the US. You can imagine that's been a great place to be over the last decade. The second strategy falls into this construct of deglobalization called the Contrarian Fund, also an incredibly successful strategy. He took over about 7 or 8 years ago. And that's been a really interesting story, kind of like the next disruptors. But most recently, why the timing of this is really good is if you want his best ideas and his partner's best ideas, co-manager's best ideas, he just launched a new active ETF called JXX, went live last Wednesday. Basically his 20 best transformational ideas called the Janus Henderson Transformational ETF. Certainly, we can bring that material to you later, but now I want to turn it over to Nick and have him go through the slide presentation, and we'd be happy to answer some questions at the end in regards to any of the points that he's made along the way. Nick, I'm going to turn it over to you. Thank you for being on the call today. We're looking forward to hearing your comments.
Yeah, thanks, Eddie, for the introduction, and thanks for everyone for joining over your lunch today. It's brand appropriate in Denver. It's a nice snowy day. I was hoping to get this presentation last week when it was 70 and sunny, which would also be Denver appropriate, but we're getting the snow. So hope everyone's warm there, and hope to shine some light on, I think, a pretty interesting topic. As Eddie mentioned, been really talking about this for probably a decade, and there's a lot of focus on this being a US phenomenon, I think, because we all sit here, but this really is a developed world phenomenon. And the world has changed today, and I think there's some pretty broad implications in terms of investing going forward as a result of that. So I'll go ahead and start on the next slide, Dan. So maybe just a recap of history, because when I was in undergrad or in business school, this is what I was always taught. I was taught the benefits of globalization and how we got lower priced goods, how that led to deflation, and we could afford more things. And as US consumers, um, we really all benefited from that. But in reality, that's not really what took place. The biggest benefits of this time period of globalization was the upper 1% of the developed world. It was the emerging market consumer, particularly in China, that really benefited as they saw their wages increase and their standard of living increase. But it has been at the expense of the middle class in both Europe and the US. And we hit a tipping point about a decade ago, and I really use Brexit as the defining point of that. But just to start with, I think if you think about history, this is what it was for the past, call it 80 years, 70 years before this new period we're entering. And what I think is important is how everyone invested over this time period was with the assumption that inflation would never be an issue again. We would have lower interest rates, we'd have a lower cost of capital. And in general, everyone on this call has really benefited from equity asset appreciation over the last several decades. So go ahead and slip to the next slide. So I touched on it briefly, but when I think about the period of globalization and I think about the period of now deglobalization, I really like to define the period of globalization as China joining the WTO. That's where we really saw the acceleration of globalization. And as I mentioned, the Chinese economy has been one of the biggest beneficiaries. The Chinese middle class has been a huge beneficiary. And what we did for 20 years is we exported deflation, but we did it at the expense of the middle class worker. And just think about the jobs across the Rust Belt that moved to Mexico, that moved to China. Those um, that population did not benefit from this period of globalization, and it really did peak with Brexit, and then it was solidified with Trump's election in 2016. So if I slip to slide 5 down. So what were some of the hallmarks of this time period of globalization? The biggest thing is we saw the longest bull market in interest rates and in fixed income investments over this time period. I think back to one of my friends, and his parents were smart enough to buy 18% treasuries during the periods of the 1980s during hyperinflation, and they still talk about those investments today. I don't think any of us are ever going to have those types of investments, but we've had a very healthy equity asset environment to invest into. But what this means is it's not just a one-way trade in terms of owning fixed income assets. When I look at client portfolios today and client cash, a lot of clients are still invested in this environment. And truthfully, they've been enjoying their 4 to 5% money market funds for the past few years. An interesting stat is if you bought the 10-year treasury a decade ago, your return on the 10-year treasury is 0. Your return on the S&P 500 over the past 10 years is 13% annualized. So I think it's really important just to have a different mindset and shift, because this period of deflation and fixed income assets appreciating in addition to the coupons you're receiving is likely over. So next slide. But what did happen during this period is we saw tremendous asset appreciation. If you think about investments from the mid-90s forward, if you owned your house, it's been a tremendous investment. With homeownership, you get a levered equity return. If you owned the equity markets, you've had to weather some volatility, but tremendous returns. I've been at Janus Henderson for 12 years. I started my career at Marsico in 2007, right in front of the financial crisis. So I actually do remember what down periods look like, even though for me, over an 18-year career, it was actually just the first 2 years where we went through a down period. When I look around the floor and the people I work with today, and I've got a lot more gray hair than I used to, and a lot more gray hair than people sitting around here. Most people sitting on our floor have actually never been through a true bear market. They only know a bull market in terms of asset appreciation. I think we had about 6 weeks during COVID where people thought they felt what a bear market felt like, but in reality, even 2020 was a good year for equity assets. So going forward to deglobalization, there's really two things I think about and I've been talking about that cemented this. So I'll talk about one being populism and two being just COVID and the weaknesses of globalization really being shown during that time period. So when I think about uh, populism, some of these quotes here really sum it up. I think the chart on the right really sums it up. 6 million manufacturing jobs lost in the US from 1979 to 2019. That's what fueled the populism. It's interesting today. I just saw that JD Vance is over in Europe at an AI summit, and the heart of the speech, and it's one of the reasons Intel's talk is up today, is all about bringing manufacturing jobs back to the U.S. So you'll hear that theme a lot today. I think it's something that is very bankable in terms of being able to invest behind. But how you invest today is different. The world going forward is much more capital intensive in Europe and the US, which leads to a number of opportunities, but it is a different environment. So populism really triggered this. If you flip to the next slide, this here sums it all up. So the biggest beneficiaries of globalization were the top 1%, and that's who the asset owners were globally. And then it's the rise in the emerging middle class. Just think about the Chinese consumer and how much they really benefit from globalization. And what you'll see on the right half of the slide is it was the European and US middle class that paid the price for globalization. And that's what fueled the populism. So there's a lot of talk in the media today about Democrats versus Republicans, left versus right. I don't think about the world at all when investing. I think of the world as this slide. Those have benefited tremendously, the top 1%, and the rising middle class that's pushing back because they didn't benefit from globalization. So the reason we have this slide here is I think obviously with the election, Trump is front and center, but this isn't just a Trump phenomenon. This really is a bipartisan and even developed world phenomenon. This is what led to Brexit. Bernie Sanders' stances on populism, the Occupy Wall Street march, they're not that different. So I think you really just have to change the mindset in terms of why the populism was created. And it's important to understand this is a very bipartisan issue. And when people are talking about elections, they're talking about bringing jobs back to the US. They're talking about bringing manufacturing back to the US. And it's a very bipartisan thing. So next slide. So one of the pushbacks I've gotten over the past decade is we can't do this. Like there's no way we can bring semiconductors back to the US. It's too hard, it's too difficult. But the problem with that assessment is one, usually those people that are telling me that have time frames of about 6 months. This isn't a 6-month phenomenon. This is a decade plus investment theme to invest behind. And then the second problem with it is we actually used to do this. So this stat to me is one of the most staggering here at the bottom. In 1990, 80% of global semiconductors were manufactured both in the US and Europe. So to say we can't do it is, I don't think, true. The fact that 90% of manufacturing capacity in the world today sits 100 miles from China across the Strait of Taiwan seems like a mistake. And when I first gave this presentation 3 or 4 years ago, it was just trust me, we can do this. Today we are doing it. I've recently met with the CFO of Taiwan Semiconductor twice, once in September and once early in December, and talked to them what they're seeing in terms of their manufacturing facility in Arizona, and they're manufacturing in Arizona at 4 nanometers today. So not quite leading edge, but really good technology. Their yields on their 4 nanometer technology in Phoenix are actually better than the yields they're seeing in Taiwan at the same node at 4 nanometers. So not quite at 3 nanometer or 2 nanometer where they're going to in Taiwan, but we can do this. We are doing this, and their customers are leading them to deglobalize and bring semiconductor capacity back to the developed world. So if we're sitting here 5, 10 years from now, most likely we'll be talking about there being 3 different lines in Phoenix, 3 different nodes. There's going to be at least 2 manufacturing facilities in Japan, and there'll be 1 in Germany. And it may be Taiwan Semiconductor that's doing, or is the company that's doing the manufacturing, but it's very much going to be a deglobalized manner. Next slide, Dan. So I touched on how populism started this.
Nick, can I ask a question on semiconductors?
Yes, go for it, Jason. Yep.
So for those of us uninformed, which is mainly me, how many people are used in making semiconductors?
Fewer and fewer. So that is one of the hallmarks of the current trend in manufacturing and bringing it back to the developed country, to the developed world, is there is going to have to be a lot of automation in that process. I don't think semiconductors didn't really require a lot of people to begin with, but if you think about pharmaceuticals or industries like that, where maybe you did have more people, a lot of these plants will be more automated, but there will be more jobs in the US.
Right. So when we talk about like deglobalization and using semiconductors as an example,
yeah,
you've said that there's been this shift in production of semiconductors from almost exclusively Taiwan, and you said United States, Japan, and Europe.
Germany.
Like, is that deglobalization or just changing locations? It seems quite global, doesn't it?
I guess when I think of globalization, I think about being produced in a cheap source, or in general, it's been from lower cost labor settings, and then exporting it to the developed world. Whereas in a world deglobalization, the manufacturing is going to be in the same location as where it's being consumed. So you're going to have a much more closer tie to production and consumption.
Okay, and I asked that question because you can see where like the discussion is going to go at some point, where we're going to go from semiconductors to like steel and aluminium or something. And I'm just sort of leading up to the question about like, how is it going to be potentially different when we go from a product that requires high technology and comparatively low labor to the reverse, where it's not really, Taiwan, you could also say, is like a developed country. So going from one developed country to another, we should just understand like how much actual labor goes into the semiconductors, and it's apparently not very much.
Yeah, so semiconductors would be very advanced technology, and TSM essentially has a monopoly in terms of where they're at today, in terms of their capabilities. But if I take it just one step next, like what industry is going to move, let's use medical devices and pharmaceuticals. That wasn't, the IP there is really the drug companies, or it was about cheap labor. So think about 3M making the COVID masks in China. They can make those in the US. It'll be a very automated facility with less labor. The pharmaceuticals, the gross margins of a small molecule are in the 90%. There's no reason that Pfizer can't make that at their manufacturing facility in Nebraska. But instead, we were making a lot of it in India. because it was cheaper. So that would be the next industry. As you get to heavier industries, do I think we're gonna get to a period where we're making furniture again in the US? Probably not. But for industries that are strategically important, we're definitely gonna move to the production to where the consumption is. You're on mute, Jason.
I have a follow-up question from the audience about semiconductors, but we can meld that into the medical devices question.
Sure.
So the follow-up question is, will onshore production of semiconductors rebound if the chips or the Inflation Reduction Acts are repealed?
So I don't think the CHIPS Act will be repealed. So that's probably a little bit different than the Inflation Reduction Act. I would separate those, and I would separate those politically. I think semiconductors are viewed as strategically important. There's a lot of parts of the IRA that, depending on your political perspective, people have different points of view. Semiconductors, I think that's much less so, and they are viewed as critically important. And then in the case of semiconductors, you have large customers like Apple who can dictate where they want their production. So it makes it easier to move. So if you're TSM and you're standing up a facility in Phoenix, you know that your customer, Apple, is going to take that production. That's much easier.
Okay. And with the semiconductors and now moving into the medical devices,
Yeah.
If the motivation behind sort of this deglobalization is the populist movement, because a lot of the gains of globalization went to a small fraction of the population, and so a larger portion of people are sort of unhappy because they feel they're not getting the benefits of this.
Yeah.
If we onshore production of semiconductors and we onshore production of medical devices, do those people actually end up better off? Like, are they getting jobs from that? Like, or they, well, where do they actually realize any benefit from this? Or do they just view deglobalization as some sort of cause of their problems? And if we have less deglobalization, are they just going to feel that there's some other cause of their unhappiness?
Yeah, so what we're seeing, and there's a slide a little bit later in the deck, is what we're starting to see is a transfer of economics to labor. So the pendulum clearly swung too far in terms of returns to capital. So we are seeing higher wage growth, and we've seen that for a number of years now. And that even in real terms, you're seeing higher wage growth. So the middle classes weren't asset owners. They didn't benefit from the capital appreciation other than through home ownership. But they are seeing higher real wages now. So that is a tangible benefit to them. So we touched a lot about the populist side of deglobalization, and that clearly started this trend. But I think this slide here is incredibly important to why the nail was put in the coffin is that globalization. And that's COVID exposed a lot of weaknesses of globalization. And if you think about just-in-time manufacturing, that worked great until it didn't. Manufacturing medical protective equipment in a foreign country worked great until that country decided to keep it all for themselves and not export it to you during COVID. Here's an interesting anecdote I like to talk about in terms of this supply chain phenomenon. We own a company called Howmet Aerospace. It's one of the leading aerospace suppliers, and they make the parts inside the hot part of the jet engine that GE makes. They also make equipment for Boeing, for our military. Boeing, in order to improve their margins, instead of buying from Howmet in the US, their titanium parts, was using a Russian supplier for a number of years to boost their profitability. So one of the largest US military contractors was relying upon a Russian company for their manufacturing of a critical component for jet engines or for jet parts for the US military. Those days of doing that are over. The just-in-time element, that I talked about no longer exists. We've seen companies spend a lot of time thinking about resiliency of supply chain. All the talk today is Gen AI, but for the last 3 to 4 years before Gen AI, it was all about resiliency of supply chain. And just think about how hard it was to buy a car in 22. And it's because there were no semiconductors and they couldn't make cars. My wife, someone hit her in early 20, in, I think it was December 21. It took them 5 months for a simple auto collision fix of her car because there were no parts. So the supply chain element can't be understated because people also learned during COVID that there are a lot of flaws in globalization, and during periods of stress, we had just gone too far. Let's go to slide 14. So a few years ago, it was, trust me, this is starting to happen. It is happening. And I talked about a little bit earlier capital investment in the US and in Europe. This has changed versus the period of globalization and something investors have to think about. It was all about maximizing free cash flow and improving capital intensity for the 2 decades of globalization. Today, it's about investing behind where the capital is being deployed. So you can really see here that the capital intensity of the US economy has picked up. When I think about where this is occurring, this is semiconductor facilities. This is really data centers. And there's increased focus on sovereignty of data centers, particularly in a world of Gen AI. If you're Japan, do you want your AI model run in a foreign country, or do you want to run it in your own country? The answer is they want to run it in their own country. So we are seeing this capital investment pick up. We're also seeing this in the power grid, and we'll touch on that a little bit later. So next slide. So just to reiterate the point here in terms of hyperscalers, this is your Mag 7 companies. This is the Microsofts, the Amazons, Googles. I would include Oracle, Meta in there, and just the amount of capital is being spent in terms of data center growth. There was a scare a couple weeks ago that this was going to come slowing down, and then all of our large hyperscale companies reported last week or two, and instead of it slowing down, they're actually accelerating their CapEx spend. And then obviously, from a political perspective, these are some US-centric slides, and we saw some announcements right after the inauguration, but this is a global phenomenon. Japan is moving incredibly fast in terms of semiconductor manufacturing, in terms of data center build out. Europe tends to move a little bit slower, but it's clearly the direction of travel as well. So then this goes to you don't have to just trust me anymore. We're starting to see it. So you can see the improvement in US manufacturing jobs in the bottom left. It is taking place. The jobs are moving back. And you see on the right, the number of industries where that manufacturing transformation is going to take place. So what does this mean for us as investors? It means inflation is higher. That's a new reality. That doesn't mean 8% that we had coming out of COVID, but it means structurally higher inflation. So I think we're in for a period of 2 to 3% inflation. That seems a reasonable run rate. That's different than the investment period of the 2000s and 10s, where inflation was 0 or almost negative. Interest rates hit 0. I'd be willing to say, make a pretty large statement that I don't think we see ZIRP, zero interest rate policy, ever again in our lifetime. I think those days are long behind us. So as you think about investing as investors, I think it's reasonable to assume a 4% Fed funds and what that means for your investments going forward. It's interesting. I started in 2007. I think back to my Vanguard Prime Money Market Fund that I owned before the financial crisis, and it used to own 5.5%. When I think about investing going forward, it looks a lot more like those days than it looks like the last 15 years of investing in the stock market. Next slide. So we are in for a period of higher Fed funds. The Fed cut rates 100 basis points last year. They're probably still tight. They probably will cut a couple of times this year to get to a more neutral rate. But we're not going back to that period of zero. And you can see that period of zero for was a lot of people's investing career all through the 2010s after COVID. It's in a different environment going forward. And I think the working assumption needs to be 3.5 to 4.5% Fed funds is the operating environment that we're in, and inflation's 2 to 3% going forward. Next slide. And this goes to your earlier question. It also means higher wage growth. And this is why there's so much populist excitement in terms of bringing jobs back, because wage growth has accelerated. Even on a real basis, it has accelerated, and the middle class is benefiting and seeing this. Next slide. So I still do expect a healthy consumer. The U.S. consumer's ability to spend should never be doubted. It's a tremendous sort of strength for our economy. But it's going to look a little bit different. It's probably less items coming from China. I think post-COVID, people probably are focused a little bit more on experiences and services versus just accumulating goods. So that the change of that spend may be a little bit different. But the American consumer is very healthy, and given the wage growth they have, I'd expect that to continue. So this is a slide I like to throw into every presentation, and it's really more just about investing in the world going forward. And I think a lot of times people ask, but the market's up so much, I've missed it. I can't invest now. I think the key takeaway is stay invested. And I think if there's one takeaway or conclusion from this presentation is, yes, the world's changed, but you still want to be invested. How you invest may be a little bit different than the last 2 decades, but you still want to stay invested, and timing the market doesn't work. And if you look at that red box there, if you're out of the market, or if your clients are out of the market and they miss the 10 best days of the year, their returns are 35% lower than someone who just stayed invested through that entire time period. So timing the market's incredibly difficult. Equity returns come from actually not a lot of number of days. And if you miss those days and try to time the market and get in, your long-term returns will be severely impacted.
So Nick, I might just ask a question, and I'm going to use the point you just made as context for the question. The specific question is on the economic situation, where you talked about wages growth is above inflation. So we've recently had positive real wages growth. And you talked about consumer spending being robust. The specific question was about global economic growth and trade patterns. So it kind of segues into the idea of, well, like that's sort of the missing piece of like the general economic picture. But then in terms of also timing the market, like, is the recent data in terms of the impact of globalization on wages, spending, and economic growth, it's hard to work out so far from your presentation, is it good or bad?
The conclusion is it's different.
Okay.
So I think it's good in the long run. And the reason I say that is because globalization broke. So it was clear that we had swung the pendulum too far, and it no longer worked. you've seen civil unrest is probably the best way to say it, both in Europe and the US. And if we're going to have a stable society, we need more than just the top 1% really benefiting from the economy. So I think it's, from an investing perspective, the conclusion is it's different. From a societal perspective, it's good. And the one thing in terms of economic growth that wasn't mentioned in your question is the capital investment going into the US and Europe is actually higher than we've seen for the previous 2 decades. So it's not about the industrial company who's increased their operating margins by 1,500 basis points because they moved the jobs out of Ohio to China. It's who has the ability to invest behind the capital that's being deployed in the economy today. So we own a company, Eaton, that is a manufacturer of electrical equipment that obviously the period of globalization was very difficult for them, but they kept a lot of their manufacturing here in the US and figured out how to do it economically. When I look at a company like that, they're seeing higher levels of revenue growth rates today than they've seen in the last 2 decades. Those are the companies we're investing behind, those companies that are able to grow as a result of the capital that's being deployed into the economy.
And is there then, so if this is a net sort of positive from society, and we're seeing increased capital investment, wages growth above inflation, robust consumer spending,
Yeah.
in your view, is there a risk that, well, there is like a response which ends up going too far where we just bring in protectionism for industries that are not all that strategic, and that leads to like a net downside for those industries?
It's possible. I would say this kind of goes to the tariff question. My working assumption is we're going to have essentially a 10% tariff on everything that comes into the US. Looking at it, generally, if it's caught in that 10% range, the people producing the goods are usually the ones that actually bear the cost of the tariff. When you go over 10%, you tend to see more price inflation and the consumer doesn't benefit. And given just the early indications of policy from the current administration, it appears that tariffs are going to be viewed as a source of revenue to help pay for other political objectives like extending individual tax cuts and other things like that. But yes, there's a risk we go too far. And the thing that I think we should highlight is the US economy today really is the strength of the globe. And I can be positive on the US and everything we just talked about, whether it's wage growth, capital deployment. That's not taking place in the rest of the world. Germany's in a recession. A lot of the German economy over the last couple of decades was built upon exporting to China. China's clearly been in a very depressed economic environment, and their economy was largely built upon exporting to the developed world. So the US has really been an island of safety and an island of economic growth when we're not in a great global GDP growth environment. Next slide, Dan. So maybe just to wrap up on a couple more market slides. The market has become very concentrated. This is just an observation, a statement. Not saying that it's been incorrect. In fact, it's been absolutely correct to be invested in the Mag 7. That's where you've seen the most resilient growth. We own a number of Mag 7 companies in our Janus 40 fund. They are the world's best defensive consumer staples. Absolutely amazing companies. but they are priced like that today. Next slide. And I would just say historically, those stocks over a longer time period actually tend to be underperform rest of the markets. So this is where we're spending a lot of our time thinking today is, obviously we have a lot of exposure. I would say most clients have exposure. The Russell 1000 growth, the top 9 stocks are over 60% of the index. The S&P 500, the Mag 7 are roughly mid 30s% of the index. So incredibly concentrated into a handful of stocks. So we're really spending a lot of time finding the next Eatons and next Howmets where we have growth that we can invest behind the trends that are taking place in the economy, and being very cognizant that most of the world owns a handful of stocks. And then I'll just wrap up on this slide because people always point to valuation as a reason to not be invested. I would just say we're actually finding tremendous numbers of opportunities in the market. We are looking differently and looking different for those opportunities. But just to say, because the market's gone up, you shouldn't invest. I would go back to the slide before, stay invested. There's tremendous economic growth in this country, and there's a number of areas where you can find that growth and great companies to invest behind. And it's not just where market leadership's been over the last 5+ years.
Is it reasonable to say that another reason why the PEs are more reasonable is because the E today is different to the E of the past, where a larger portion of the expense items that flow through to earnings is R&D. So compared to the past, like we're depressing the earnings per share part, and even if the PE is above what you've heard in the past, it's not really comparing like with like.
It's not like for like, and also it's, despite me saying that we're putting a lot more capital into the economy, which is absolutely true because you're seeing the hyperscalers put in tremendous amounts of CapEx. The economy today is much less asset intensive than it has been in the past. So just think of software companies and how tremendous those businesses are. And the US economy is actually much less asset. And this is one of the results of globalization, is the US economy is much less capital intensive than both Europe and Asia. It's February, so people have already forgotten, but March or January 1st every year, I get the charts of why you should buy overseas stocks, how much cheaper Europe is versus the US, but no acknowledgement that the European stock market is made of energy companies and banks, and the US economy is made of tremendous, generally non-capital intensive growth companies.
Right. So it's not really buying Europe versus the US, it's buying old economy versus new economy companies.
It's buying innovation versus buying old economy. And even if you look in Europe, like the companies where there is growth, they get tremendous valuations. They get very high multiples because people are seeking where there is innovation. It's just the US has fostered an economy where we create a ton of innovation.
And do you see, like, adjusting for industry composition, that the PEs are roughly the same in the two regions?
Generally, I mean, I like to use financials and banks. The European banks trade a little bit cheaper. Generally, their balance sheets haven't been as healthy, and American banks tend to have a little bit more fee income. But the more I go like for like across industries, they're more similar than different.
Okay. One of the questions we have in the chat is about education and academic collaborations and whether they will be altered by deglobalization. Do you see like a constraint on collaborative research or a constraint on even the export of education? We export both in the US and Australia. We export a lot of education from international students. Do you think that that will shift with this deglobalization?
Yeah, so it's interesting. When you first read the question, I was actually thinking of it differently. So I'll answer both. In terms of education system, like clearly something has to change. I don't want to get into a political discussion on immigration, but how we retain highly educated workers and our immigration policy around that has plenty of room for improvement. So I think that has been true for the past decade, is that students come to the US to get world-class education. But as opposed to 2 decades ago when they were staying here, a lot more of them have been going home. When you first asked the question, I thought what I thought of is, how is education and industry going to be more collaborative? And I think actually you'll see improved collaboration there. So if I think about Intel building a semiconductor plant in Columbus and the collaboration with Ohio State to train students to have the technical expertise to go into those industries, I actually think you're going to see increased collaboration there in terms of the engineering and science fields. That could be semiconductors, that could be aerospace. But I think industry realizes it has a greater responsibility to help create training grounds in our education system.
And I think the final question we have in the chat is about the potential political pushback to deglobalization. So your point to motivate the talk was that the top 1% of population have benefited at the expense of the middle class. And if we're seeing this shift back towards middle class prosperity to some degree with higher wages growth, the top 1% can be quite influential in terms of political influence. Like, is there a risk that they then respond in some way to shift the tide back towards things that benefit them?
I think they've been trying, and I think if there's a conclusion of the election, it's the forces of the middle class have issued a mandate. Not that they won't try, but I think just given the sheer numbers of people who are seeing the benefits of deglobalization, I think politicians in particular are realizing it's a bipartisan issue to create that next job in the US. And I think there's a lot of tailwinds behind that.
Yeah, I guess maybe the top 1%, maybe their avenue for the pushback is the tax angle, to try to simply allow deglobalization to occur, but keep the pressure on for lower taxes, which would be the most direct benefit.
Yeah, I think the top 1% will be okay.
Well, that's we've exhausted the questions. This has been fabulous. Thank you so much for those insights. We've had over 100 people attend the webinar. That was lots of fun, and we look forward to seeing you again.
Thank you so much, Jason. This is the best that I can do as far as what I look like, guys. This is my 1999 linked profile picture. I do not look like this anymore. I have no hair now, but when I see you, hopefully I will see some of you out there. I'm looking forward to getting to know you. We're going to follow up with some materials in regards to the strategies that Nick runs. We've gotten questions around some of the stock holdings. I want to remind you that JXX is a concentrated 20 stock strategy, which culminates around his thoughts today. But all I would ask for is just a little bit of an open door and maybe having a conversation over the next few months as we reach out. Thank you all for having us. Jason, thanks for setting all this up. And Lauren and Michelle, who are on the call, we're grateful to have the opportunity. We'll look forward to seeing you guys shortly.
Great. Thanks, folks. See you again.
Thanks, everyone.
Bye, everyone.